All right, back for the second part of international trade. There'll probably be a couple other parts as well. So I'm just trying to break it up into smaller chunks so that so you don't have to sit through the whole entire lecture. It might be a little bit easier for you, and also it might be easier to upload these onto YouTube. So what I want to talk about right now is the idea of of one world price. This applies to most goods and certainly to goods that are commodities. So what I want to do is I want to focus on the world of one price with respect to, let's say, oil. So let's imagine we have a situation where the United States and Saudi Arabia are not trading with each other. Both of them produce and consume oil. And try to imagine that before these countries get together, the price of oil in the United States is higher than the price of oil in Saudi Arabia. That might be because we here in the United States have been pulling oil out of the ground for the last 150 years or so. So we've already tapped into a lot of the easy oil. Now, when we want to pull oil out of the ground, we have to frack for it, break up rock, or go into the middle of the Gulf of Mexico, or go up to Alaska or somewhere. So the price is going to be high in the United States, and we also do consume quite a bit of oil. And then imagine that in Saudi Arabia, they produce a lot of oil, but because the oil in Saudi Arabia is easy to get to, it's maybe lies in big pools close to the ground, that the price is relatively cheap. So the story that we're going to tell here with the world of one price, with the law of one price, is that when Saudi Arabia and the United States starts trading with each other, the price in the United States is going to drop, and the price in Saudi Arabia is going to rise. And eventually we'll get to one world price, which we're going to call PW, and that will be the price that a buyer of oil can buy oil at, and that would also be the price that a seller of oil can sell oil at. So let's imagine that you are a buyer of oil in the United States. We'll start off with the US first, and then we'll go to Saudi Arabia. Imagine that you're used to paying PUS, and now all of a sudden you have the opportunity to buy oil from Saudi Arabia because the two countries are trading with each other at a price way down here of PSA. So then the question is, who would you rather buy your oil from? Somebody in your own country that's going to charge you PUS, or the nice people in Saudi Arabia who are only going to charge you PSA? And the answer is you'll buy oil at the cheaper price from people in Saudi Arabia. All right, now imagine you're a seller of oil in Saudi Arabia, and you're used to getting PSA for your oil, this price way down here, and the nice people in the United States have in the past have been willing to pay PUS. Who would you rather sell your oil to? Well, you'd rather sell it to somebody in another country that's willing to pay you a higher price. So you'll start selling your oil to people in the US, and the net effect is going to be over time that the price in the US is going to drop, the price in Saudi Arabia is going to rise, and we'll eventually get to one world price for oil. This especially applies to commodities more than anything else, because when we're talking about a product that's a commodity, there's very little difference between, let's say, if we're using oil as our example of a commodity, the kind of oil that we produce here in the United States compared to the kind of oil that's produced in Saudi Arabia. I mean, there are slight differences, but at the end of the day, anybody who is in the business of turning oil into gasoline, let's say, can deal with these differences. All right, so now if everybody in the world is either paying PW or receiving PW, it might look like we've got markets that are out of balance in the U.S. and Saudi Arabia, but that's not the case. At a price of PW, domestic supply, which I'm calling QDS, is less than domestic demand, which I'm calling QDD. But the difference between these two are imports. It's oil coming from Saudi Arabia. And then if we go to Saudi Arabia, it's just the opposite. QDD, which is domestic quantity demanded in Saudi Arabia, is less than QDS. I'm not saying that there's no surplus in Saudi Arabia. The difference between domestic quantity demanded, QDD, and QDS is export. So that's the oil that Saudi Arabia is sending to the U.S. And what you have to imagine is that the amount of oil that Saudi Arabia is exporting is equal to the amount of oil that the U.S. is importing. All right, so now what I want to do is turn to this thing we call consumer and producer surplus to take a look at what the net effects are going to be in these countries. So area A over here is this triangle, the area below the demand curve and above PW. Area B is this rectangle over here. Area E is this triangle. Area D is this triangle. Area F is this triangle. And area C is this funky shape thing over here above the supply curve. So before Saudi Arabia started trading oil with the rest of the world, the price was PSA. All right, so let's take a look at how this is going to affect people in Saudi Arabia now if Saudi Arabia were to start trading and the price were to go up to PW. So when the price is PSA, consumer surplus, which is the area below the demand curve and above the price, would be A, B, and E. So this area over here that consists of A, B, and E would be the value that consumers get from participating in the market economy for oil within Saudi Arabia. All right, what about producer surplus? Producer surplus is the area above the supply curve and below the price. And remember, what we're saying is the price in Saudi Arabia is PSA, so producer surplus would be C and F over here. All right, so now try to imagine that Saudi Arabia starts trading with, starts exporting oil to people in other countries. They have a comparative advantage in the production of oil. As a result of that, now Saudi producers, instead of getting PSA, are going to be able to get PW. How is that going to affect consumers and producers in Saudi Arabia? Well, now that the price is PW, consumer surplus in Saudi Arabia is only A. Okay, so before consumers had A, B, and E, now Saudi consumers of oil are only going to have A over here. All right, what about Saudi producers? How are they going to be impacted by the higher price of oil? Well, first off, the definition of producer surplus, we have to keep that in mind, is the area above the supply curve and below the price. The price is now PW, so producer surplus is going to consist of B, E, D, C, and F. Well, that's interesting. B and E used to belong to Saudi consumers. So a portion of Saudi consumer surplus got transferred to producers when the price went up. C and F was part of producer surplus before, and D is the gain from trade. In other words, this is how much better off the country is net, regardless of whether or not consumers are worse off and producers are better off. The country picked up this area D that didn't exist before. That's a gain from trade. Why is this important? Because if we were concerned about, let's say, Saudi consumers losing B and E, we could transfer B and E back to Saudi consumers and leave Saudi producers with D, and they'd still be better off because now they would have C, F, and D, and consumers in Saudi Arabia would have A, B, and E. So they wouldn't have, the consumers wouldn't have suffered a loss, and the producers would have still been able to gain D over here. So people in the exporting country are better off as a result of trade. What about in the importing country? So we're going to assume the U.S. is the importing country. We're also going to assume that before the U.S. started trading with Saudi Arabia, the price of oil was PUS. Why is that important? Because consumer surplus in the United States is just this area, area A. That's the area below the demand curve and above PUS. All right, what about domestic producer surplus in the United States when the price is PUS? Well, that's the area above the supply curve and below the price. So that is areas C, B, and E. All right, so the United States starts trading with Saudi Arabia. The price drops from PUS to PW. How is this going to affect domestic consumers? Well, domestic consumers are still going to have A, but they're going to pick up area B, E, and D. Now, B and E used to belong to domestic producers of oil in the United States, but it just got transferred to consumers of oil. So if we were worried about, like, let's say, I don't know, ExxonMobil or Chevron, then maybe what we could do is we could transfer B and E back to them. And American consumers would still be better off because they'd pick up area D over here. Do you see what I'm saying? So in other words, producers wouldn't be at a loss because the price dropped and the quantity went up. They would still have area D, which is the gain from trade in the United States because now consumers are able to buy more oil, QDD, at a lower price, right? PW is a lower price than PUS. By the way, I'm not saying we should transfer the B&E back to domestic producers, but I'm just saying that in the case of domestic consumers, a lot of us might have said, well, gee, that's not working out too well for consumers. Maybe they should get B&E back. But in the case of, let's say, the oil companies, people probably don't have the same opinion. They probably wouldn't want to transfer that back to producers. All right. So let's talk a little bit about this is actually something that came out in on NPR a while back in 2007. It was an article talking about how our policy, our ethanol policy, has affected the market for corn tortillas in Mexico. So let me explain what's going on. In the early 2000s, when President Bush got elected, Bush 43 that is, he passed a law, or they implemented a policy that said that oil companies had to mix in ethanol with their gasoline. Now, a lot of people think that because Bush is from Texas, that he's in the pockets of the oil companies, and a lot of people might say, well, this must be something the oil companies dreamed up. Actually, the oil companies hate that. They know how to make oil. They've been doing that for a while now, 100, 150 years or so, and they don't need to be mixing ethanol, which is alcohol, in with their gasoline. So why did Bush do this? He did this as payback to people in the Midwest who help him get elected. As you might know, they grow a lot of corn in the Midwest in states like Iowa and Nebraska and those kind of places. And so one way to get corn farmers in those states a higher price would be to require that the oil companies mix in ethanol made from corn. It had to be made from corn in with their gasoline. All right, well, what effect did this have on the market for corn? Remember, corn can go into one of two things. It can go into making ethanol, which will be then mixed in with gasoline, or it can go into making some kind of a food product, like let's say corn tortillas in Mexico. So it turns out Mexico imports quite a bit of corn from the United States to turn into tortillas. The increased demand in for corn in the U.S. because of ethanol production led to an increase in the price of corn going into Mexican tortillas. Now, you would expect that the demand for corn tortillas in Mexico, because that's a necessity food, right, would be relatively inelastic, right? Meaning that because the demand for something that's a necessity is more inelastic, you wouldn't expect there to be a big decrease in quantity as a result of an increase in the price. It turns out, though, that the demand for corn going into tortillas was relatively elastic, meaning that some people in Mexico, probably the lower income people in Mexico, were actually not buying as much in the way of corn tortillas as they were before. So, one thing to maybe think about when you're filling up your tank is, you're putting in gasoline with a little bit of ethanol made from corn. It's kind of like taking a tortilla out of the mouth of somebody in Mexico. No, I'm just kidding, but it's not too far from the truth anyway. So I'm going to end it here, and then we're going to talk about tariffs and quotas.